Now let's look at derivatives. So derivatives, these are financial instruments which derive their value from one or more underlying assets. So the value of the derivative is determined by the fluctuation in the value of the underlying asset. Now, as a conservative CPA, I'll say that derivatives, they can be very deceptive. Something like the Midas golden touch. So derivatives, these deceptive derivatives, they seem to shine like the sun, like gold. So the mnemonic for you to remember the characteristics of derivatives is SUN, sun. Now the S stands for settlement in cash or equivalents. So we'll talk about this. Derivative contracts are generally settled in cash or equivalents. So you might have a derivative contract for commodities, but there's no exchange of commodities. You settle it off in cash. In cash or equivalents. The U, this stands for underlying price, underlying asset. So you have an underlying price of the derivative into the notional amount. So that's the number of derivative instruments. So you could have 1,000 options. That's a notional amount. So we'll look at that. The N, that stands for no or negligible net investment. And let's understand all this using an example. So you could have options as one form of derivatives. Now options, that's something like a real life thing, right? So a lot of times you have options to do certain things. Now an option means you would do it if you want to. That means you have the right to do it, but not the obligation. So that is again options for derivative contracts. So let's look at options where you have right but no obligation. Let's say Apple is trading at $500 and I got $2,000 in my pocket. I could go out and buy 4 stocks of Apple. Now instead of that, I could also buy call options for Apple stock at $2 each. So the call option states that I have an option to buy Apple stock at $520. So guys, understand, it's currently trading at 500 and I have an option to buy it at 520. And this option costs me just $2 each. And I buy 1,000 of such options. So instead of spending my $2,000 in buying 4 stocks of Apple, I spend those $2,000 in buying 1,000 call options. Now, what happens in this case is, let us say the price of Apple stock, that goes to $530. So the market, if you go out, you'll have to buy it for $530. Now, I have 1,000 call options to buy this stock at 520. It's gone to 530, but my call option, that's 520. So I have an option to buy, a call option. So I could buy it at 520. So what I could do is I could buy 1,000 stocks for 520 and sell it for 530. Now I don't do all that buying or selling. Instead what we do is we do a net settlement. So I enter into a contract and I take those options, I encash it and I get $10,000 in cash. Because it's 530. If I had bought it for 520, sold it for 530, I would have gained $10 per option. 1,000 options, $10,000. Now, how about the price of Apple stock is somewhere between 500 to 520. It's like 510. Would it make sense for me to buy it at 520? I could instead go to the market, buy it for 510. So in that case, I would not exercise my option because my option gives me the right, not the obligation. So that's the call option when you want to buy. I could also have a put option. So if I'm not too positive about the stock, if I think the stock would go down, I would go for a put option. Let's say I go for a put option at 480 and this is an option to sell. Now, in this case, what would happen is I would have an option to sell this stock at, let's say, 480. So if this stock plummets, if it goes down below 480, let's say it goes down to 460, I could buy it from the market at 460 and sell it at 480 because I have an option to sell, a put option. Now, I won't be buying and selling. We would have a settlement in cash. So I would be getting, let's say, for 1,000 options, $20,000. So guys, I'm sure you're getting this concept that if it's a put option, the price goes below this, I can buy at that price, sell at this, make a gain. How about I have a put option, but the price does not go below 480. Let's say the price is 500 or 510 or 490. Does it make sense for me to buy it at 490 or 500 or 510 and sell it at 480? I won't do that. So I would let my options expire because my options, they give me a right, no obligation for me to exercise those options. So guys, as you can understand, with just $2,000 in my pocket, instead of controlling just 4 stocks of, let's say, $500 each, I now control $500,000 of stock. So I have 1,000 into 500, $500,000 of stock I control with just $2,000. So that is what derivatives can make you do. I know they seem very attractive, but as I told you, remember, they could be very deceptive and very complicated. That's why they shine like the sun. So guys, that was about options. So we talked about call option, option to buy, put option, option to sell. So call means buy, put means sell. Now, you could also have futures, forwards, swaps. So we looked at options, futures, forwards, swaps. Now, options, as I told you, is right, not obligation. In this cases, it's right plus obligation. So these are basically contracts to buy or sell goods or currency in the future at the price set today. So you decide a price today and you're going to do the exchange in the future. So that becomes future. Now, future is basically a standardized terms. So these are traded on the exchange. So it's standardized. It's decided, at this particular future date, we're going to exchange at the price set today. Now, forward, that's like a customized future, customized contract between two parties. So this could be customized. Now, when you're looking at swaps, swap means what? Exchange. Generally, you look at currency swaps, interest rate swaps. So let's say I want to swap dollars for pounds. So that's a currency swap. So you have swaps for currency, for interest rates. Now, on the CPA exam, we are not really getting into a lot of detail about derivatives. As I told you, they can be very complicated. But we'll come back and we'll talk about accounting for derivatives. We are accountants. So our basic goal is to learn about accounting for derivatives, and we're going to focus on hedging. Hedging means stay where you are, and I'll tell you what it means.
On page 16, FAR 3.2, we're looking at derivatives and hedge accounting. Now, derivatives are financial instruments or other contracts that derive their value from underlyings like stocks, bonds, commodities, currencies, interest rates, and market indices. Now, derivatives, these have a multiplier effect, and our mnemonic here is sun to the power of n. The first one, derivatives are highlight settled net. That means it's a net settlement in underline cash or cash equivalents. And on the bubble, write S to the power of n. So settled net. Second bullet, highlight underlying and notional amount. So on the bubble there, write u to the power of n, where the u is underlying and n is the notional amount. So the value of the derivative is the product of the underlying and the notional amount. Right there, settlement price equals underlying dollars multiplied by notional number of units. So underline underlying and right there, strike dollars. Underline notional amount and write the number of units. And the third characteristic is highlight no or negligible initial net investment and write n to the power of n on the bubble. So guys, derivatives are settled net. Derivatives have underlying and notional amount and they have no or negligible initial net investment requirement, and that is where we say derivatives, that's sun to the power of n or s to the power of n, u to the power of n and n to the power of n.
On the second half of page 16, highlight types of derivative instruments. Highlight option contract and right there, right plus obligation, and cross out obligation because it's a right but not an obligation. Next line, underline call option and write hope equals price would increase. Next line, underline put option and write hope equals price would go down. Highlight futures and forward contracts and write right plus obligation. Underline futures, underline long position and write expect equals price would go up. Underline short position, right, expect equals price would go down. Underline forward. So futures have standardized terms and traded on an exchange. Forward, they are customized as per the need of the parties. Highlight swaps and write right plus obligation. Underline interest rate swap. Underline foreign currency swap. And write expect equals what you will receive is more than what you will pay. So guys, these are all your types of derivative instruments. So we looked at options, we looked at futures and forwards, and we've also seen swaps. When we're looking at accounting for derivatives, remember that derivatives are always measured at fair value. On your financials, you can have a derivative asset or a derivative liability. Now, derivative contracts could be for speculation. Basically, you're trying to speculate in an attempt to profit from market changes by using derivatives. Or it could be for hedging purposes. Let's say you're really worried about what's going to happen tomorrow. You're worried about the uncertainty that's there in the future. So you want to hedge yourself. You basically want to stay where you currently are in the present. So you might want to enter into a derivative contract for hedging purposes. So let's look at speculation versus hedging. So speculation, we look at fair value hedge and we look at cash flow hedge. Now, speculation is something like, as I told you, speculating to attempt to profit from market changes. It's something like betting. Try to place a bet so that you get money. Any unrealized gains or losses from derivative contracts for speculative purposes, that goes on to your income statement. Now, fair value hedge is when you're trying to hedge against the risk of loss from existing asset or an existing commitment. So the asset is already there with you and you're worried it might lose value. So you're trying to enter into a hedge. So let's say you own inventory and you're worried that the market value of this inventory may fall. So you enter into a fair value hedge. Now in that case, any unrealized gains or losses that you have would again go into your income statement because you already have this asset. So if this asset loses value, you would have an unrealized gain from derivative. So that would offset the loss. We'll look at that. Cash flow hedge. Let's say you try to hedge against the risk of loss from a planned or forecasted future transaction. It's not an existing asset, not a current legal commitment. It's a future proposed transaction. You want to hedge for that. So let's say you plan to buy inventory. Now, if you're trying to hedge against the pricing for a future transaction like planning to buy inventory, that becomes a cash flow hedge, and any unrealized gains or losses is not taken to the income statement. Instead, you park it on your accumulated OCI in your balance sheet. Guys, think about it. You haven't bought the inventory yet. You're planning to buy it. So if you have an unrealized gains or losses from a derivative contract for hedging against this future transaction, hedging for this future transaction, you would not want to have it on your income statement. You would park it on your balance sheet in accumulated OCI for now. Next year, when you actually buy the inventory, that is when you would want to take it out of accumulated OCI, put it on your income statement. So for now, you're parking it. And OCI, if you remember, that was PACE. Now, A of PACE, we just learned. It's available for sale securities, unrealized gain or loss. The E of PACE, this stands for the effective portion of cash flow hedges. So any unrealized gains or losses on cash flow hedges, park it in accumulated OCI. That's the E of your PACE. Now, to understand this concept of fair value hedge and cash flow hedge, let us look at an example that we have on the book. So it says, Aerofuel, an oil distributor, has purchased $100 million of gasoline from its supplier refinery on 1st November. Now, they plan to sell this oil, this inventory that they own, to various airlines in early Jan, but are concerned that the price of oil might drop considerably from the current selling price of 94 cents per gallon. So they've got 100 million gallons and they're worried that the price may drop. The current price is 94 cents. So that makes it $94 million for 100 million gallons. So they're worried that the price may drop. If the price drops, naturally they got the inventory. They're going to lose money. To protect the inventory, the client gets on the sell side of a gasoline's futures contract based on a wholesale gasoline price index per gallon, the underlying times $100 million gallons, the notional amount, with the settlement date of Jan 2nd. So what they do is they enter into a futures contract. So what would happen is they've got into the sell side of the futures contract. So if they lose money on the inventory, they're going to gain money on the futures contract because they're on the sell side of the contract. So assume that the price of the index drops 4 cents per gallon by the end of the year. So guys, the price drops 4 cents, 100 million gallons, they're going to lose $4 million. So loss to inventory, that is going to be $4 million. This loss goes into the income statement. Now, they had thought about this. They were worried about this. That's why they entered into a hedge, a futures contract. Now, they are on the sell side of the futures contract. Now, guys, think about it. They have the right and the obligation to sell 100 million gallons at 94 cents. Now, the market price has dropped. What they could do is they could buy the gasoline at $90 million, 90 cents from the market and sell it at 94 cents. Now, they're not required to do all that because we know in derivatives it's a cash settlement. So what will happen is they will have a receivable, a gain from the derivative of $4 million. So guys, they've lost money here. But from the futures contract, because they're on the sell side of the contract, the price has fallen. But they can sell it at the price that they entered into. So they have a gain there. So they have a receivable and gain from the derivative contract. Now what we're saying is this gain is not yet realized. The settlement date is 2nd January. But in case of fair value hedge, this goes on to the income statement. So this gain would go to the income statement. So in other words, what's going to happen is this $4 million of loss, income statement. $4 million of gain, income statement. What's the net income statement effect? 0. So this is a wash. That is why you entered into a hedge, because you didn't want a loss because of decline in market values of inventory. On the other hand, if there was an increase in the market value of inventory, they might have gained from the increase in the value of inventory, but they would have lost money on the derivative on the futures. Now let us look at it from the perspective of the airline. So it says, next one. Let us go back to November and look at the side of the King Airlines that is planning on purchasing the gasoline in early Jan. Now, the King Airline gets on a buy side of a gasoline futures contract with the same notional amount of 100 million gallons. And there's a price decline of 4 cents per gallon. Now guys, looking at from the airline perspective, which is planning to buy the inventory. Think about it. Now, the price has fallen. So now next year they can go out and buy cheaper inventory. So next year they would have a gain because they would be able to buy the inventory cheaper than they thought. But because they entered into a buy side of the futures contract, they have lost money on the derivative. So what we do right now is the money that they have lost, we will not put it on the income statement. We will park it in accumulated OCI. Let me just do it. So the loss goes to accumulated OCI on the balance sheet. Let's say $4 million for 100 million gallons. And this is a payable that they have on the derivative. So guys, there are two different transactions that we're looking at here. Number one, this is the actual inventory. This one is the derivative. These guys, the fuel suppliers who are on the sell side of the futures contract, they have gained. For them, it's a receivable. The airline, which was on the buy side, they have lost. So for them, it's a payable. So it's basically the two sides. Now, they've lost money this year, but next year, they're going to go out and buy cheap inventory. So now, let us try to put this on the balance sheet and understand why we are trying to park it in accumulated OCI. So let's get to our dashboard. Take this. Now, first, let's look at the fuel suppliers. So they had a 4 million loss because of decline in inventory, and they had a 4 million gain on the derivative. So net 0. Now let us look at from the perspective of the airline. For whom it was a cash flow hedge. They didn't own the inventory yet. So when they had a loss of $4 million on the derivative, we said we're going to put it, so on tide no C, in OCI, and that gets to the accumulated OCI on the balance sheet. Now let's say on year 2 they go out to the market and actually buy the inventory. Now they won't be paying $94 million. They just get the inventory for $90 million because it's cheaper now. The value of inventory has dropped. So what's going to be the cost of goods purchased? So it's going to be 90 million, not 94 million. Now what we're going to do is this 4 million of loss which is lying in accumulated OCI, we're going to take it out from here and put it on the income statement. So we're going to take it out from here. We're going to take it, reclassify it and put the loss out here. What's 90 and 4? 94. Guys, think about it. The airline was okay with paying $94 million. They didn't want to pay more than 94. They were okay with 94. Now they have had a gain because inventory has become cheaper. So what we do is we take this $4 million in accumulated OCI, put it on the income statement. So this 90 plus 4 becomes 94. So what you do is basically the 4 million negative that you had in OCI last year, this year it's 4 million gain on OCI. This becomes like a loss on your income statement. So at year 1 end, you had a 4 million of loss in accumulated OCI. On year 2, nothing. You've taken it out. You've reclassified it to the income statement. So basically, the airline said that they are happy being where they are. So they said, you know, $94 million, that's the current price of inventory. We are okay with that. We don't want to pay more than that. But actually, the price declined. So they had a gain on inventory. Instead of paying 94, they had to pay 90 for inventory the next year. But they had a loss on this derivative which got reclassified. So ultimately their expense number remained 94. So that is what hedging is. You want to stay where you are. You want to stay at the present levels. You're worried about uncertainty. So you hedge it. So guys, cash flow hedge, you park it in accumulated OCI. When the transaction actually happens, then you take it out and put it on the income statement. If it's a fair value hedge, directly goes on to the income statement. On page 17, we are looking at accounting for derivatives and hedges. Highlight measured at fair value. Right, hedge equals use derivative to offset risk of anticipated losses. Now, we've got a lovely table here where we're comparing speculation versus hedging. So, speculation is when you attempt to profit from market changes. Gains or losses for speculation, they go to the income statement. Speculation, that sounds like, right, betting. Next column, we have got fair value hedge. This is hedging against the risk of loss from an existing or already recognized asset or liability or a firm purchase commitment. Gains or losses, they go to highlight income from continuing operations on income statement. Now this is because the receivable or the payable or the commitment, all these highlight exist now. And make a note below this column, already have inventory. Next column, we're looking at cash flow hedge. This is hedging against the risk of loss from a planned or forecasted future transaction, but not yet a legal commitment. Gains or losses, they go to highlight OCI pays in the balance sheet. Highlight nothing in income statement until the transaction actually occurs. And write plan to buy inventory. On the second half of this page, we're looking at examples of derivatives. The first one, that's on speculation. Look at the journal entry there. So because it was a gain from speculation, the debit was to the receivable on derivative, the credit was to gain on derivative, which goes to right there I/S or income statement. Turn on to page 18 and here we have examples on fair value hedge as well as cash flow hedge. A few lines on that example highlight underlying and highlight notional amount. So we know that underlying multiplied by the notional amount, that's the settlement price. Now let's look at the journal entries. For the fair value hedge, the first journal entry was the loss on market decline in inventory. So on the left, write inventory loss, underline loss and write I/S because this loss goes to your income statement. The gain, that's on the derivative, the fair value hedge. So write derivative fair value hedge. And on the credit, underline gain, write I/S. So we have seen that the 4 million loss on inventory, that went to the income statement. The 4 million gain on the derivative, the fair value hedge, even that has gone to the income statement. So circle the 4 loss and the 4 gain, draw arrows out from them and write wash because of hedge. Highlight both the loss on inventory and the gain on the fair value hedge are included in the computation of net income. So there is no net income effect. And this of course was the goal of the hedge. Next, we're looking at the cash flow hedge. Now, going to the journal entry there, write derivative cash flow hedge. And the debit here is to the loss on the cash flow hedge. Underline loss, write B/S because this loss goes to accumulated OCI on the balance sheet. Circle the 4 million and write loss on derivative will be offset by future planned transaction. Hence, it's parked in accumulated OCI on the balance sheet now. Let's read. It says, note that the loss is not included in the calculation of net income. The reason is that the highlight decline in gasoline is expected to reduce the cost of inventory in the next period. So this loss will be offset by reduction of cost of sales in the next period only. The last bullet on this page, you got a summary for fair value hedges and cash flow hedges. The second sub-bullet, highlight cash flow hedges and write accumulated OCI equals pace. Circle the E, draw an arrow from E and write effective portion of cash flow hedges. So we now know that the E of pace in accumulated OCI, that's the effective portion of cash flow hedges, the unrealized gains or losses on such hedges. Now we know that derivatives, they shine like the sun and they could be pretty complicated. So naturally there'll be a lot of required disclosures like how and why an entity uses derivatives. Do they use it for speculation, for fair value hedge, for cash flow hedges? What's the method the entity uses to account for derivatives and hedging instruments and the effect of such derivatives and hedges on the entity's financial statements? Now, we've been talking about disclosures when we did financial instruments. We said it's required to disclose credit risk, and here we're especially looking at concentrations of credit risk. Have you put all your eggs in one basket? And it's optional to disclose market risk. Okay, now that we're looking at derivatives, let me also talk about hybrid instruments. So that could be a host instrument with an embedded derivative. So that's like, let's say we're looking at a convertible bond. Now, the bond is a debt security. The conversion option is an embedded derivative with a host instrument, and that becomes a hybrid instruments. So ideally, we're looking at two items. Number one, the bond. Number two, the conversion option. The bond, that's a security. The conversion option, that's an embedded derivative. Now, in case of such hybrid instruments, you may use bifurcation so as to have a separate fair value for the host instrument, in this case the bond, and the embedded derivative, in this case the conversion option. Now let's look at this on the book, and with this we're done with derivatives and hedging.
On page 19, we have the disclosure requirements for derivatives. So the first sub-bullet talks about the information which enables financial statement users to understand key information about those derivatives. The second sub-bullet talks about disclosures of the objectives for holding or issuing derivatives and strategies for achieving those objectives. Few lines below, we have disclosure regarding inherent risks of derivatives. Put a box around required, because there is a required disclosure for highlight concentration of credit risk. So credit risk, that's the risk of default. And if that credit risk, the risk of default is concentrated, make sure you disclose it. So look at this. In the example on the fair value hedge, Aerofuel faces the risk that the other party may refuse to pay the $4 million net settlement. So that's the risk of default credit risk. There is, put a box around optional disclosure for highlight market risk. Market risk is a risk that the entity incurs a loss on the derivative, and that's an optional disclosure.